Okay, good morning, everyone. Can you just let me know in the chat function if you can hear me? Okay, great. So in today's session, we are going to continue with Learning Unit 5, which is recording credit and sundry transactions. Now, last week, we briefly discussed what it is, and we looked at the relevant journals. Now, in today's session, we are going to look at question 5.4, where we're going to work through the information and show you how to capture it into the journals. And for today's one specifically, we're going to look at the general journal, and this is one where a lot of students struggled last year with the format and how to actually document it. So that's why I'm going to focus on this question to make sure that we are sure that you know how to do it. Okay, so let's quickly just recap a few things from last week. Okay, so the first thing is to recap is we said when we talk about credit journals, there's basically 4 credit journals, and then we've got our sundry journal, which is our general journal. Now, the first journal is our data and debtors allowance journal that go together. Now, your debtors journal summarizes all your credit sales to your customers for goods and services, and for that, we have a duplicate credit invoice that is our source document. Whereas the credit allowance journal summarizes any returns to their customer or rebates that we provided to the customer, but it relates specifically to a transaction we've already captured in the debtors journal. So if we have not captured anything in the debtors journal, that transaction would normally then go to our general ledger. Okay, and remember, we only record credit sales in our debtors journal. Cash sales are always recorded in our cash book receipts journal. So just remember that. Only credit sales get recorded in our debtors journals. Now let's quickly look at what the structure looked like again. So the main things you need to remember when you think about debtors control. The main column is our debtors control column, and it will always be debited because we are selling things to a third party, so the money that we will receive once they pay us will actually increase our assets. Then we will credit the output VAT as well as the sales account and any other sundry accounts, which does not fall under those 2 items. Now, if we've got a perpetual inventory system, we will have the cost of sales column. Okay, now remember, our debtors control is the main column, and that is VAT inclusive. So if they tell you the amount is VAT exclusive, you will have to convert it first before capturing it in there. If it is VAT inclusive, you just take that amount as is and put it into that column. Okay, our sales amount, on the other hand, is the amount excluding VAT. Okay, because we captured the VAT separately in the output VAT column. And then our cost of inventory sold is also an amount excluding VAT, and we always take the sales value and then apply the markup percentages. However, if there are trade discounts that are applicable, you will take the debtors control value and then first take out the VAT amount and then apply the markup percentage to get to your cost of sales. Then for debtors allowance, very similar to what we have for our debtors journal, the only difference is basically is instead of debiting debtors control, we are crediting it, we are reducing it, and then output VAT changes to input VAT, and sales change to sales returns. Okay, and then it's just going in the opposite direction for our general ledger accounts. For our creditors journal, so that's our second grouping, this is where we document any credit purchases. So debtors, credit sales, creditors, purchases. Okay, so this is what we buy from a supplier. Our documentation we receive here is original credit invoice, And then the creditors allowance journal is where we summarize any returns to our supplier or rebates we received on the goods from our supplier. But similar to the debtors journal, it had to be previously recorded in your creditors journal in this instance. The format or the structure of your creditors journal looks very similar to that of your debtors journal. The difference is creditors control is our main column, similar to debtors control. Because creditors is a liability, it will be credited, so it will increase on the credit side. And then we will debit input VAT and trading inventory. If it is a periodic system, trading inventory would change to purchases. Okay, now what is very important, only these totals at the bottom of the journals is what we are transferring to our general journals. Okay, so we don't take each and every individual item to the general journals or general ledger. We only take the subtotals. Okay, and then you can see, similar to what we said with the debtors control, your main column is always inclusive of that, whereas your trading inventory is always exclusive of that. So make sure that you know what includes that, what excludes that. Your creditors allowance journal, the only difference from your creditors journal is the VAT column. Instead of input VAT, it goes to output VAT. Okay, and then the direction where you will put it in your general ledger will just be in the opposite direction. Now, general journal, this is basically the last journal where we capture any transaction that does not fall into your 3 cash journals or your 4 credit journals. Okay, so I've summarized the abbreviations just behind it of what those journals are. This structure looks a lot different to your other journals because of the fact that it doesn't have columns. We have a description or details, which is your general ledger account name. We've got a debit and a credit column. We've got a document number, which is your journal voucher number. You've got the date, and then the folio would normally be your balance sheets or your nominal account numbers, but you won't necessarily have that information available. So let's quickly look at what that structure would look like. So you can see here at the beginning, we've got the document number. Here you would have a JV, journal voucher, and a number. You've got the date. The details is the account name. The folio would be your account number, so whether it's a B1 or N1, this column you would leave open because of the fact that you won't have the information, and then you've got your debits and credits. Now, what's very important, once you're done with the transaction, the debit side, the value should always equal the credit side so that you know that you have actually balanced that specific transaction. And then once we are done with it, so that we show the users that this is the end of the journal, we include a narration. So it's a short description of what did we actually do in the specific transaction, so that when you go back, you know exactly what each transaction was for. Okay, now I'm just going to repeat it again because a lot of students lost marks with this last year. Please do not confuse this with a trial balance. If they ask for a general journal, this is the format that you follow. If they ask for a trial balance, it will look different. We will do an example of a trial balance as well, but just be sure that you know the distinction between the two and read carefully what type of information are they requesting from you. Okay, so what I want us to do first is we're going to start with question 5.4 that we discussed that you had for homework. So I'm going to put it up on the screen. Let me just stop sharing here. So if you've got your textbook available, it is on page 162. Now, just before we start with question 5.4, I got the latest pass. I'm just going to put it up on the screen if you want to take a photo, specifically for this module. Your assignment, they've moved the date now to the 4th of May. The reason for this is the assignment will only be available at the end of March. They've changed it. So from the communication we received, a portion will be on VC Learn. So you will submit a portion on VC Learn, and then there is a portion that you will have to submit manually, which you will have to go work out. Now, because of the fact that it's not finalized as yet, they have moved out the date to the 4th of May to give you guys sufficient time to be able to complete your assignment. Okay, as you can see, you need to submit it by 9 o'clock. And then your test one has been moved out to the 23rd of May at 11 o'clock. Okay, so just make notes of those dates in your journals or in your diaries, just so that you are aware of the fact when you need to do all of your assessments. Okay, and I will communicate the IELTS activities once that is due, once that has been communicated. Okay, so let's look at question 5.4. So what I'm going to do is I'm going to read through the information with you, and then I'm going to show you what you're supposed to highlight when you do a question like this, so that you know exactly when you get something like this in the test or in an assignment or in the exam, how you should approach it. Okay, now the first thing you always do when you get a question, doesn't matter whether it's an assignment, in a test, is you scroll to the bottom, or in your case, you page to the bottom, and you go look, okay, what do we have to do? So in this one, they say, interpret the information provided and make the necessary entries in the general journal. Okay, so they want to capture it in the general journal. Now, the general journal, we said, has a details column, which is our account names, and it's got a debit and credit column that shows which side of the general ledger account will be debited or credited for that specific account. Okay, and this is for the month of August. Now let's scroll right to the beginning and let's start at the top. Okay, so they tell you August was the 4th month of trading. Now, why do they tell you it's the 4th month of trading? This is specifically for your journal number. Okay, so that means our general journal would be general journal number 4. That's basically what it tells you. Then they tell you we are registered VAT vendor, and we only trade with registered vendors that are able to supply a valid tax invoice. Now, what that means is we need to raise output VAT on sales, and we can claim input VAT on purchases. Okay, but that is now unless they are exempt or zero rated items, but that is what this information means. So because of the fact that we have valid tax invoices, we can claim the input VAT on anything we've purchased. The next important thing you had to note is we use the perpetual inventory system. This tells you, on the other hand, that any purchases gets captured to our trading inventory account. Okay, so this one goes to our asset account, and then when we sell it, we move it to cost of sales. So this is why you need to make sure what inventory system are we busy with when you do a question like this. Okay, then they go on, the following information relates to all the transactions entered during August, which affected the general journal. So they tell you this only affects your general journal. It doesn't affect anything else. Then the most recent journal voucher number was JV18. Okay, issued on the 31st. Now, why do they tell you that? They tell you what the previous journal number is. Now, when we issue journal numbers, it will be in sequence. So that would mean your first transaction would then start with JV19. Okay, so this is what the information means, just to guide you what the document number is, because they won't indicate it in the specific transactions. Then they tell you the business does not expect to award any settlement discounts or qualify for any settlement discounts. Now, the reason they tell you that is so that you account for the full value. If there is a settlement discount at the end of the day, then you'll put it in the general journal. Otherwise, you would have to account for that information when you captured it initially. So in your module, we do not expect to have settlement discounts or qualify for them for that reason. Okay, and then all occurrences of settlement discounts are incidental in nature. So if they happen, they would be small. They won't have a massive impact on our business. That is why we account for them only when they occur, and we do not anticipate them beforehand. Okay, before we go to the individual transactions, do you guys have any questions on that intro paragraph? Is there anything that you don't understand or you want me to just re-explain? If you are good, just show me a thumbs up or smiley face in the chat function. If you've got a question, you're welcome to pick up your mic, or you can type it in the chat function if you want. Okay, so Nicholas asked, what happens if the fourth month was not added in the text? Would it just be general journal? Okay, so Nicholas, normally they will then in the question, so in the solution, they would already give you the document number at the top, so the GJ number, or you would just write GJ. Okay, so you don't normally get marks for it, but that is what the information means. They would either give it to you, or if they don't give it to you, you would just do the normal abbreviation and leave out the number. Okay, then Zindile asked, can you re-explain the settlement part? Okay, so Zindile, the settlement part, when we talk about settlement discounts, that is where we get a discount if we pay our accounts before within a certain period of time. So normally it's a 7-day period after you receive your invoice or your account. Then a lot of suppliers will actually provide you with a discount. Similar to us, if our customers pay us within 7 days, we will give them a discount. It is to motivate your customer or our suppliers to motivate us to pay them sooner. Now, in this question, what they're saying is we don't anticipate that we are going to pay off an account before that settlement period. So we will probably use the full 30 days as opposed to the 7 days. And similar with our clients, we don't expect our clients to pay it beforehand. The reason they state that is if you expect your clients will make use of that, you actually have to already account for that discount when you record the sales transaction in your debtors journal. But if you don't think they're going to use that settlement discount period, so you think they're going to do the normal 30 days, then you account for the sale for the normal value, and then if they do make use of this discount, then you only do a separate entry in your general journal. Does that make sense to you? Sandile, did I answer your question? Okay. If you've got any other questions as I go along, please just stop me and then I'll re-explain it. So we're going to go through each and every transaction, and then I'm going to discuss the transaction. We're going to record it as we go along, so that when the information's still fresh in your memory, you can see how you need to apply it. Okay, so let's look at the first one. On the 1st of August, the owner, George Ruby, made a capital contribution. So it's a capital contribution. They tell you in the form of furniture. Okay, so because it was not cash, this is why it's going to our general journal again, with a fair value of 15,000. Okay, so that is what that furniture is worth. Since the furniture was purchased more than 6 months ago, no notional input VAT was allowed by SARS. Okay, so no input VAT was allowed, so that means we cannot claim input VAT, so the full amount would have to go to our furniture. Okay, so I'm just going to stop sharing here, and then I'm going to share the Excel file with you guys. Okay, so just let me know if you can see the Excel file on your side. Okay, so you should see the Excel file now. Okay, so the first thing you see is here is the format. This is what you would receive in a test. You would get this outline. Okay, these lines here at the bottom, they wouldn't give that to you. That I've already done myself so that I can see where each transaction ends. But they would just give you these columns with the headings. Okay, now we know that the previous month's journal voucher ended with JV18. So this means this document number should be JV19. Okay, so that's our document number. The day is the date it happened, so it was on the 1st. Okay, now we have to do 2 accounts. Now the one is we received a capital contribution from our owner, and the second one is we received furniture. Now who can tell me what account are we going to debit? So what account are we debiting? Okay, so Zandile thinks equipment. Any other takers? What does the rest of you think? What account will we debit? If you're not sure, then you can type in there in the chat function you're also unsure. That's also an answer. I just want to get a feel for where you guys are at with this. Okay, while you guys are thinking, what are we going to credit? Kalino thinks maybe we'll debit furniture. Okay, so in this scenario, because it was furniture, we would use the account name furniture. In practice, we would have furniture and equipment. We would actually combine the 2 accounts together because some of it would be seen more as furniture, some would be more equipment. So to try and eliminate the confusion in practice, we would actually combine the 2 account names. So normally what you have to do is take what information they provide to you and use that as guidance for what account name it could potentially be. Okay, so because we could not claim any VAT, that amount will be the full 15,000. Okay, otherwise, if we were allowed to claim VAT, this would have been a VAT exclusive amount. Okay, now what is the credit side of it? We've captured the furniture we've received. But what did the owner actually give the business? Capital. That's correct, Lesedi and Zindile. So capital. So we're going to credit capital. Now here you would remember I said there's a slight indent here to show you what is being debited, what is being credited. That is why furniture is on the far left-hand side. And let me just make it slightly bigger, then you can see that on the screen. So you'll see there's a slight indent here, which shows that's a debit, this is a credit. That is how we write debits and credits when we write the details to help us make sure we capture it on the correct side. Now then the next thing you have to do is you have to add your narration. Now you can either put it in brackets or you can do it in this format. To just show it differently, you have to show it differently than your account names, just so that you know it's a description and not an account name. So your description would be, we received a capital contribution by George Oribi, and you can even state what have they contributed. Okay, but it's not a requirement. A description like this would be perfect. Okay, let's move on to the second transaction. So on the 6th, okay, Zindile, why do you debit furniture instead of equipment? Is there an account called furniture? So Zindile, yes, there is an account called furniture. You could also call it furniture and equipment. We would also mark that correct. So where you combine the two terms together. Let me just quickly see on page the account names in your textbook. So in your textbook on page 53, Zindile, you will have, they call it the chart of accounts. They've got under the non-current assets, we've got equipment, we've got furniture. So that is where you would see there is an account with the name furniture. Because we use furniture, you would rather use, or were given furniture, I would rather use the term furniture for the account name. But if you're unsure if it's furniture or equipment, you can also combine the two names. Okay, but normally in the question, especially if it's a bit vague, they would also tell you if it's equipment, then they will tell you in brackets it's equipment. But with something like this, we would have generally marked furniture or furniture and equipment, we would have marked correct. Zindile, does that answer your question? Okay, so let's look at a transaction on the 5th. So the owner took trading inventory that would have been sold to the public for 4,731 Rand, okay, including that for personal use. Okay, now this would have been sold to the public for that value. This means that is the sales value. So I'm just going to write here, sales value. The markup on cost was 33.25%. Okay, now let's start with our first question. When an owner takes inventory out of the business, what value would they be prepared to pay for it? If you took inventory out of your own business, at what value would you pay for it? Okay, so Niels and Dile Lino says, what about the cost price? Yes, you would only pay the cost price. You will not actually pay the markup. You will pay what you paid for it. Now, what this information tells us is they've given us the sales value. They tell you this is what it would have been sold to the public. So this is the sales value. It's inclusive of that. Now, what is very important, when an owner takes trading inventory, he also takes the VAT portion with it. But because we claimed the VAT initially when we purchased it, we would have to reverse the VAT as well. And then the markup percentage, it is on cost 33.1%. Yes. Someone's mic is on. Do you have a question? Did someone have a question for me? Okay, so let's see how are we going to capture this now in our general journal. So the first thing I want you to do, before you even start with the question, is go document what is the cost price, what is the markup percentage, what is the sales price. Now we know the markup percentage is 33.25%. They've told us this. Because it is on cost price, that means our cost represents the 100%, and our sales value would then be 133.25, which is adding those two together. Okay, so that is step one. Go work out what the markup ratios will look like. Okay. Now, if we go complete this, we know the document number is now going to be JB20 because they go in consecutive number order. The day is the 5th. When an owner takes inventory out of a business, what do we call that again? There's a specific term we use in accounting for that. I'm just going to repeat that. If an owner takes inventory out of a business, what is the term we use for that? That's correct, guys. Drawings. Now, you can tell me, is drawings debited or credited when we put it into our general ledger accounts? Think dead click. Where did the drawings lie when we did that dead click one? Debited, that's correct. So drawings is debited. Now what is very important, it will be at the cost, but the amount will include the VAT. So this is where you will see I've taken the 4,731, which is the amount inclusive of VAT, and then I've adjusted that for our markup percentage here on the side to get to a value of 3,548 Rand and 25 cents. But what I've also said is originally when we acquired the inventory, we would have claimed input VAT. So when the owner takes that inventory then out of the business, I will have to raise output VAT as well for that transaction. So I will raise output VAT based on the value, based on the cost amount he's taking out. Now that amount is inclusive of VAT. I would multiply it with 15 over 115, and then the amount going to the trading inventory would be the difference between what went to drawings and the VAT component I've taken out. And then the narration is the last step. I would write here, the owner took inventory for own use. Okay, before we move on to the next transaction, do you guys have any questions on this one? Okay, do you guys have any questions on this transaction? Okay, let's move on to, yes. Yes, you can speak.
I wanted to know, when you calculate the cost price, you first have to take off the VAT first on the sales, then calculate the cost price, or do you calculate it with the VAT, then take it off?
Okay, so remember when we do the cost of sales, we normally take the VAT out first. But because of the fact that it's drawings, how SARS works is SARS says if the owner takes inventory for their own personal benefit, then they are not allowed to claim the VAT. So that's why the drawings amount is the one including VAT. So you could have also taken the cost of sales value and just added the VAT amount back. Okay, Zandile, why do we have output VAT if the goods were taken for personal use? Okay, now Zandile, remember, inventory, the inventory amount that we've captured originally did not include any VAT. So I'm just gonna, let me quickly add a space in here. So if you purchased it, so I'm just gonna write here, just show you what the original transaction would have looked like. So when we bought it initially, we would have said debit inventory or trading inventory. And the value would have been the 3085,43. This is what I would have paid for it. Sorry, let me just make this. Okay. So we would have debited the trading inventory. We would have debited input VAT. And the input VAT would have been this amount. And then we would have credited, let's say, creditors control, we bought it on credit. Okay, so this is when we acquired it initially. When we purchased it initially, this is what the transaction would have looked like. You would have said debit inventory, so we would have increased our stock with the original cost. Now remember, the original cost excludes VAT because of the fact that we could claim the input VAT, but the amount we would have paid to debtors control would have been the amount inclusive of VAT. But now what happens is I'm not going to sell this inventory at all, but it has been taken out of the inventories. Now I'm going to take out the inventory amount, make it 0. So I take the same value it came in at, and I take it out now at the same value. Now, because of the fact that the owner is using it for his own personal use, they call it a change of intention in tax terms. SARS says, okay, fine, originally I allowed you to claim the input VAT because you were going to use this for your business. You would have sold this inventory and you would have raised output VAT, which I would then have received my money. But now because the owner is taking it, I am no longer getting that money. So now I expect the owner to pay that output VAT on the inventory they've taken. And this is why we create output VAT. And the amount the owner takes is inclusive of the VAT. So the owner is effectively now paying for that VAT and not the business. So this is why you take it to output VAT. You are reversing the original input VAT that you claimed, and you're taking it out because the owner is now paying for the VAT component. Sandile, does that make sense to you? Okay, I'm glad you asked this. A lot of students do struggle with this concept. This is the reason for it. Okay, let's look at the following transaction. Okay, this is going to be very similar to one I've done now. Okay, 333, how did you get? Okay, Siri, did you just use 0.33 or did you use a few more? If there's a slight difference, it's normally because of a rounding of the percentage.
Ma'am, I use 0.33.
Yes, so I put in an additional 3s. I have about 4.3333. Then you get to the correct answer. But if you only use to the second decimal, we would still mark it correct because it's just a rounding difference because of where you cut off the percentage.
Oh, okay, so thank you, ma'am.
Okay, let's then look at the 6. Now, the 5th is very similar to the 6th, and now I expect you guys to tell me how we are going to record this transaction. So now we're going to practice if you guys understand the concept. So the owner took trading inventory that would have been sold to the public for 5,928, including that. What value does that amount represent? What value did they give you there? That 5,928. What value does it represent? You can just type it in the chat function with me, guys. What value did they give you there? Okay, Leslie, no, it's not the cost price. Nicholas, it's correct. It's the sales value. And the reason it's the sales value is because they told you it's been sold to the public. Sorry, let me just get the line again. This portion here tells you it's the sales value. Okay, now in this instance, they give you a markup on the selling price was 40%. Now, if the markup is 40% on the selling price, where would the 100% be in our equation? Would it be on the cost or would it be on the selling price line item? That's correct, Nicholas, on the sales price. Okay, so let's go see how do we actually record this. So we start, before we even start with the question, we start with our markup percentages. Now we said because it's on selling price, this would be 100%. They said the markup percentage was 40%. So that means our cost price is now 60. So it's the 100 less the 40 will give you the 60. Then we know the next journal number would be JV21. The date is the 6th. Okay, now who can tell me what are you going to debit and what will the value be? What account am I debiting and what will my value be? I'm going to put the information just up on the screen. So tell me what account will you debit and what value would you debit? Okay, so Lino says we are debiting drawings. That's correct. Lino, do you know what the value would be? Okay, so the rest of you, what will you debit? We're debiting drawings. What is the value we're going to take to drawings? Okay, do you guys want to explain to me how do you think we'll get to the value we are going to debit to drawings? Okay, I see you guys are struggling a bit. So let me show you. So you take that 5,928 Rand. That's the amount inclusive of that. So that's the amount we are going to sell to the public. We want to know what the cost price is. So we multiply it with the 60. We currently have the sales value of 100. So we divide it by 100 and we get to a value of 3556,80. Now, because of the fact that the owner is using it for his own personal use, remember the drawings amount will be including the VAT. But now we have to reverse the VAT as well as reverse the trading inventory to reflect the fact that we have no stock and that the owner will now be paying for that VAT component. So similar to what we've done in the previous transaction, you would then take that drawings amount and you will multiply it with 15 over 115 to get to the VAT portion, and then the trading inventory would just be the difference between the two, or alternatively you could have taken the 3556,80, multiply with 100 over 115. And then the last step is just putting in owner took inventory for own use. Okay, so the only difference with the previous one was just the markup percentage. So if you missed it, you would have worked it out incorrectly. So you would have received the marks for the account names, and then you would have lost the mark for the drawings calculation, and then you would have received method marks for the other amounts. Okay, let's look what happened on the 8th. So the owner took office stationery for use by his daughter, since it is the start of a new school year. The stationery was brand new and was purchased a few days ago for 365 Rand and 54 cents, including VAT. Okay. So we've just purchased this inventory, so they've already given you the value, so the original cost. This is the original cost amount. So this is what the drawings amount will be. For stationery, we would have originally claimed the input VAT, so we would have to read output VAT again, and then the difference would go to a reduction of our inventory. So let's quickly have a look what the transaction would look like. So drawings, you would capture the drawings amount that they've given to you. Oh, I see, I made a little slight error. It should be 365.54. That is the amount in there. And then to work out the VAT portion, we multiply this with 15 over 115 to get VAT that we would have originally claimed for 47 Rand and 68 cents. And then the difference goes to our stationery account, whereas the previous ones went to trading inventory, because stationery is not our trading inventory, but we still used it for our personal benefit. Okay, I'm going to do one more transaction and then we're going to take a break. Okay, so I know this is a little blurry, so I'm just going to read it here. We received 885 Rand from a debtor in full settlement of his account of 900 Rand. Now, if they paid us 885 for full settlement, that means we provided a settlement discount. And how do we know what the settlement discount was? It is the 900 they were supposed to pay less than 885, which they did pay, which means we received a discount of 15 Rand. Okay, but now a very important thing is, remember this 900 Rand included output VAT that we had to pay over to SARS. Now, if we're not getting in the full 900 Rand, SARS then says, okay, fine, if you give a discount to your customer, then you will also be allowed to claim a portion of the VAT back because of the fact that you haven't actually received it from your customer. So that, for that reason, your journal would look as follows. So you start with debit your sales, you debit your input VAT, and you credit your creditors control. Now the creditors control, I've written there the name of the debtor in there. The reason we do this is when you get to the second semester, when you have to do a debtor's reconciliation or you have to do the debtor statement, it is a lot quicker to work it out if you have written down which debtor what transaction relates to to be able to update the information. Okay, so we know we gave him 15 Rand discount. Now the VAT portion included in that 15 Rand is the 15 multiplied with 15 over 115. So there was 1 Rand and 96 cents of VAT included in there. And then the difference goes to our sales. So our sales value will also be less because of the fact that we haven't actually sold that amount because of the settlement discount. Okay, so this is what a settlement discount journal will look like. Do you guys have any questions on the settlement discount journal before we take a break?